Everybody, welcome to today's webinar. We're going to be covering the topic of buy-sell agreements. So if that isn't what you were looking for, you probably found the wrong webinar room. But
you got lucky.
Yes, you're here. Exactly, yes. I'm Dan Beenken with the Advanced Iowa program at the University of Northern Iowa. I'm excited to have Drew Larson with me here today from the BrownWinick firm. He's a man that needs no introduction, of course, but I will give a quick one. He's an attorney, so if you notice the Q&A box, you can add in your favorite attorney joke. I'm sure he's heard most of them, but I'd like to see some of the better ones.
Always looking for a good one.
We'll see what we can get out of there. He's a Cyclone and a Hawkeye grad.
That's right.
And 3 kids.
3 munchkins, that's right.
Great. And so done a lot of buy-sell agreements, and excited to kind of share with us what you got today. And nobody's going to learn a lot from listening to me, so let's get going.
Yeah, sounds good. So like Dan mentioned, I'm an attorney at BrownWinick. I primarily do corporate law and estate planning. So the buy-sell agreements are a wonderful confluence of both of those issues. As you can imagine, these things are, everyone's situation is different. So there is some customization, but my goal today is to walk through the goals that everyone really are looking to achieve and talking about what those are and recognizing where everyone's sort of coming from, and then discussing some of the primary ways and decisions you're going to have to make to really get a buy-sell that works for you. So first things first, what is a buy-sell agreement? Functionally, it's agreement between usually owners, about how they're going to deal with stock ownership, transfers, and sort of the unexpected. But it can also cover certain governance matters too, similar to a voting trust, so it might deal with like who gets to appoint board members and things like that. Whenever we're talking about this, as many of you know, if you've ever had to form a business or if you've Googled it even once, there's lots of different entity types that you have some options and tax regimes to choose from. I'm going to talk about this in the context, I'm going to use the corporate terminology. So corporation, company, shares, shareholder, owner. But the reality is most of the principles we're going to be talking about here will definitely apply to any other entity type that you may have, whether it be an LLC or otherwise. There's some limited nuances occasionally for taxes and how those things are treated, but for the most part, the principles remain the same in how you're dealing with those things. So broadly speaking, what are the big topical areas that anyone needs to cover in a buy-sell, right? The first is, I'm a big believer in this, like, have a conversation about the goals. A piece of paper can say what you want, but it's all about trying to achieve the goals of those owners and shareholders. We'll talk about, once you've sort of set those goals and those parameters, you're gonna have to deal with a handful of things to make that happen. One is the triggering events. Again, a buy-sell, like its name would indicate, it's gonna talk about times where someone's gonna buy, someone's gonna sell. Those triggering events are pretty critical in defining the circumstances in which someone either has the right or obligation to buy or sell stock in a company. We'll talk about authorized buyers. So who are the people, if a triggering event is met, that have the right to buy? Is it everyone else in the business? Is it just certain parties? Those kinds of things. We'll talk about valuations. I'm not a valuation expert, but we can talk about different mechanisms we can use to set a value. We'll talk about payment terms, financing, and finally, our favorite topic, taxes, right? So goals. Everyone has different goals, but there are certain ones, and the situation will drive a lot of the goals that you're trying to achieve in a buy-sell, right? Everyone, and I think this is true, hopefully everyone goes into negotiating a buy-sell with the goal of communicating and protecting their reasonable expectations and minimizing eventual conflict, right? Many people call these the business prenup, and it really is about trying to decide how we're going to work things out if they don't go as expected. And the reality is every business transitions one way or another. Even if it goes 80 years, a shareholder dies, a shareholder transitions, management changes. So having some expectations about that and communicating about that up front can be critical.
How often do you see these used correctly as a prenup for 2 partners that say they're going to get along great, and then
I think for the most part, that's actually why they're entering into it, but they're also trying to protect their families. So let's just say it's a professional services business. Often the question becomes, what happens if both Dan and I, we start a business and we're clearly graphic designers. We know our design work. If you can't tell, we're very into this. So we go and start a business, but I'm getting into this business relying on your personal skill and that you're going to be working full time there. You're relying on me. I get hit by a bus. you probably don't want half your business owned by my spouse.
Okay.
But I also want my spouse to get some value and be protected if something does happen to me.
Sure.
So we don't know which of us may suffer that kind of consequence or that circumstance. And so we want to get something that's fair for everyone.
Unless I push you in front of that bus.
Admittedly, but even up front, I prefer that we know that and we have a plan for it.
Okay.
So yeah, I think it's actually that the breakup, if things are going well and everyone's in it, they actually don't come into play that often, but they do come into play on sales transfers and someone wants out. Multi-generational, so depending on the business, right? So in our example, we're going to start a company now. We're probably not thinking a lot about fourth generation transfers of ownership. Sure. But here in Iowa, there are many family-owned businesses, whether it's first generation moving to second or fifth to sixth. Figuring out how to do that in a tax-efficient way to transition management and ownership. And those things are different. And so trying to figure out those issues and having a structure. Often the worst outcome is no plan at all. And so having some plan, even if it's a choice that maybe not everyone loves, often leads to better results and no decisions at all. These are often used as well for internal sales. So companies often that maybe don't have a transition plan or a strong one yet, or maybe they don't have kids who want to own the business or something like that. They might have a key employee that they want to give the option, and they want to lock that employee in. They want to be give them the opportunity to potentially own this at some point. Yeah. And you know, the kinds of employees that sometimes you really want are the ones who are motivated and want to own part of that business. But at the same time, you want to protect yourself if they don't work out. You want to get paid for the value you created before they come in. So often we're trying to figure out how to manage that internal sale and price it. We can set whatever value we want. The next one is protecting company viability. By this, I really mean cash flow viability. Okay. As you can imagine, again, if we have a successful design company and I want to buy you out, or I want out. So Dan, I'm going to California, right?
Breaks.
And you want to buy me out. The company may not. Let's just say my interest is worth $500,000. The business may not be able to support writing a $500,000 check tomorrow, right? And so thinking about how to finance that and pay it over time and what is an appropriate risk balance for that, whether we'll finance it with, say, insurance, those kinds of things. Sure. So, but the company, at the end of the day, it's the golden goose, and everyone tends to win if the golden goose stays healthy. There's estate planning reasons and tax, incentive comp, we sort of talked about a little bit, and control all sort of roll into the goals that people are trying to figure out.
Okay, so you definitely recommend these for folks. I mean, you work with a lot of startups too, and you know, oftentimes there's a partnership involved at some level, right? And
I always say, like, look, I'll do a corporate formation for you with partners without a buy-sell, but it is the first and one I really encourage people to get. All right. Even a basic right of first refusal, I think it's worth doing up front, only because they do dissolve. They do not work out. And sometimes just having something in place or having talked about it is valuable. There's plenty of other things you can punt on. I don't view this as one of them. Okay. I really encourage people to have it.
Great.
Yeah. So yeah, the first of those big goals, or those big, we talked about goals. So once you sort of know what your goal is, right, that starts flowing into execution and how you build these. And the first thing you're often going to decide is, and it'll be driven by those goals, is what are the triggering events. Different people have different terms for this, offer events, whatever, but what are the trigger events that either are going to force a sale or an option to buy or something like that? The first four you see on that list are all pretty standard, right? So a voluntary transfer, Dan and I are in business, I want out and I want to sell it to Bob. That generally what we're going to say is we're going to give a right of first refusal to Dan. Dan wanted to get into business with me for whatever reason. He may still want to be in business with me. He doesn't know Bob and he may not want to be in business with Bob. Sure. So he gets the option to buy me out first.
So that ties your hands from a negotiation standpoint a little bit. Do you agree upon the price at that point then as well, I assume?
Yeah, so often we've had a price built in. Okay. And again, there's lots of ways to do that, and we will discuss that, but it could be what the third party offered. It could be some other mechanism within a price. Okay. Yep. Okay. So you have lots of options. Involuntary transfers, excluding death, tend to be things like bankruptcy or divorce, where, let's just say it's me and God forbid I get divorced. You may want to stay partners with me, but you may not want to be partners with my ex-wife, who probably is not excited to be partners with me anymore at this point. So those involuntary transfers are often going to give the company or other partners the ability to buy those interests out. And again, is going to set a price up front to be fair.
Oh, okay.
Yep. So that's those are the most common involuntary transfer triggers. Death. There's lots of ways to approach the death triggering event. Sometimes it's a mandatory buyout. So if I pass away, I want my spouse to have to get paid out. She does not want the piece of paper, and I want you to do that. So often we will finance this with insurance, for example.
Yep, that the company typically pays and can deduct as an expense, right?
Exactly. The other option is it can be optional. So it may be the kind of thing where my spouse would have the option of selling it to the company for some period of time.
Okay.
And there's lots of different, sometimes it's mandatory up front, sometimes the company has an ongoing option, but you can build out, depending on what you're trying to accomplish, what happens on that those triggering events. Disability is one that sometimes does, sometimes doesn't. I see it much more often in, again, a professional services firm.
Sure.
If we're an established manufacturer and I pass away, I may not be mission critical to the success of the business. Of course, we all think we are, but we're all at least somewhat replaceable. But in a professional services business, whether it be my law firm, an accounting firm, financial advisory, if I can't perform the services anymore, I'm not bringing a lot to the table. And so the ability to buy that out on that and a long-term disability. And again, they are defined very long-term. This isn't like I broke my leg and I'm laid up for 2 weeks. It tends to be 6 months. It tends to tie to insurance definitions of disability. Now we're getting, these later ones are a little more special, but you do see them occasionally. Termination of employment. Again, if you were giving equity to someone in relation to their employment, often you will have a right of first refusal or the ability to buy back upon termination of their employment. That may be done in the contract with that employee, but it may also be built into the buy-sell.
Okay.
Retirement. So again, this tends to be in multi-generational situations or something like that is, are we going to force retirement at some point? What are the age requirements going to be? So this is one of those areas where I know when you start saying like age, you got to be gone, like there's always some dangers.
Sure.
I always say I got to go talk to my employment attorneys on the specifics on that. But those are important sort of questions.
Do you see that fairly common in the generational businesses or not really?
Not as often as you think, but we do see it. We see it more in, again, professional services. So doctors and physician groups often have mandatory retirement ages, law firms, accounting firms, stuff like that.
Yeah, we want to keep you moving along.
Well, exactly right. There's some point where they're going to put me out to pasture.
Right on. Okay.
The last two are more interesting, and often the first one, the put call option, or I frequently call it the shotgun buy-sell agreement, but it's trying to deal with that 50-50 partnership where we just can't figure out where we want to go now, right? I always joke, everyone's like, well, you should always have someone who's 51%. And I go, that in theory sounds really good until you have to go to two partners who feel like they're equal founders.
Absolutely.
And you say, well,
who's
Dan,
the 49?
I know we're equal, but I clearly should be the 51, right? So I end up with tons of 50-50 partnerships. And this is sort of the backdrop. If nothing, we really can't solve a problem here, and we can't agree on anything. What's going to happen? And the way a put-call option works is if there's really an impasse, I call it, I think it's best explained by analogy. When you were a kid, if you ever bought a candy bar with your brother, your mom bought you one candy bar or a cookie or something. She went to Dan. Dan, you split the cookie and your brother gets to get it. Right?
Sure.
It's the same basic concept. Is one party is going to say, this isn't working. I'm going to pick the price. I'm going to go to you, Dan, and I'm going to say, I will buy you out for $500,000. Or I think the price is $500 for half. And you can decide if you're selling to me for $500 or I'm buying you out for $500.
Okay.
So the first one gets to pick the price. They're cutting the cookie. The second person decides which half they want.
And that's pretty literally how it can work?
That's pretty literally how it can work.
Okay.
There's some people in the state, and they'll tell you themselves, but that they've sold very large businesses, basically with this principle. Like he walks up, here is my number. The other guy had to pay $1 more, and he decided he wanted it.
I would think 50-50 partnerships are probably the norm. Fortunately,
it's very common.
Maybe fortunately or unfortunately, but
I mean, it's just the nature of things, right?
Sure.
It's easier to find two people who have the same passion than 4 or 6 or 8.
Right, absolutely.
And so this is a way, you hope it doesn't get used a lot, but it's a way if we really can't agree on where we want to go. It's a bit of the nuclear option, but it's a way of forcing it instead of fighting about it or having to go to court or litigating. We have a mechanism. One of us is going to put our money where our mouth is.
So these don't get exercised all that often?
Not super often, but they do occasionally.
Okay.
The last ones you tend to see in a lot of it, if you've brought in any sort of outside capital, it's more common to see drag and tag along rights. But you will see them occasionally in other circumstances or intergenerational businesses. But basically these deal with a situation where we want to preserve the ability of the company to sell to a third party at sort of maximum value while protecting a minority shareholder.
Okay.
And so drag along rights, functionally what they say is if a majority group, and maybe it's one person, I'll just say the majority owner, wants to sell the business, it's way more valuable to sell a whole thing than it is to sell 65% of it, right?
Sure.
So if a 50% ownership group wants to sell, they can basically force the other remaining minority shareholders to sell on the same terms. And that's, again, they can be more complex than that, but for the most part, it's what's good for the goose is good for the gander.
Sure.
If I'm going to sell it $100 a share, you're going to
That's
get
also
the same
who
deal.
has the gold makes the rules.
Yeah.
Kind of thing. Okay.
And so you can drag them along. On the other hand, the tag along is really a protection for the minority.
Okay.
So if the majority does sell their 65% and they get a great price for it, but they don't bring you along, the minority says, hey, you either need to get the buyer to buy me too.
Right. Sure. I don't want to be left here.
We're all going to sell proportionately and we're all going to be left here.
Okay.
Proportionately.
Okay.
So they're reciprocal ideas, but it really deals with that sale provision is you want to be able to sell the whole company at a price that's equal for everyone. And we want to give the majority the ability to do that. On the other hand, we don't want someone to get left behind, and that's the protection for giving those rights to that majority shareholder.
Okay.
We talked about this a little bit in the death context, but we can decide what triggering events we want to have in the buy-sell agreement. But after that, then we want to ask ourselves, does it make a mandatory purchase? Is it an option? So most of the time, a voluntary transfer and involuntary transfer, most times it is a voluntary matter for the buyer.
Okay.
So if I want to sell to Bob in my example,
yep,
I'm going to give the company and then usually the other shareholders a chance to buy me out. They get some period of time to make a decision about that. If they either don't make a decision or say, no, I don't want it, I can then go sell to that third party.
Okay.
That's usually the way it works. You can lock it down more or less, but that's the general rule. Death is one where it's often more mandatory, and the timing becomes more important. Disability may too, especially if there are things where you're insuring against. You want to get paid that insurance, so it tends to be tied to something that's required.
Okay.
But yeah, and then the other piece is what's fair to everyone. I always love, fair.
Fair in quotes.
Yeah, and it is in quotes. It's fair really depends on your goals and what people perceive to be fair. I always say fair is what a couple people who are fully informed and rational and capable of making decisions, right, agree is fair for them, right? So there are deals that I've helped with that would I have done the deal? No, but they both knew what they were getting into. They thought that was going to be best for them, and they did it. So that's fair at the end of the day. But, looking at what you have in there, there are sometimes challenges between generations. There are sometimes challenges between strong personalities. But we're trying to decide on fairness at a time when we're getting along. I always joke, it's way easier to decide on this when we're not in it than it is later on when there is conflict or maybe there's been a death.
Correct.
And you're negotiating not with your business partner, but your business partner's mourning ex. And that's just a tougher situation.
Will the dollars start to get real?
Well, yeah, and what I thought was fair, and I know how much you were doing. My spouse may not value you as highly as I do, Dave.
Right.
So,
sure.
Yeah, or may value you less, but she's still going to want the amount that's set forth in the agreement, right?
Yeah.
And I wouldn't blame her. So,
okay.
So we talked about triggering events, and often the question then becomes is who gets to buy? We've hit the trigger. What happens next? And so we'll often say once these triggering events, we're going to offer this to the company first. We're going to then offer it to the other shareholders, for example.
Okay.
So again, let's just say I have a 50%. Let's make it 3 shareholders. We each own a third.
All right. We got Bob with us.
Yeah,
right
Bob. That's right. We brought Bob in, so we're all third owners.
Okay.
The traditional way would tend to offer the company, I want to sell my shares. Generally speaking, we'd offer it to the company for purchase first so they can redeem my shares. And then you two would end up at 50%. You just eliminate my shares from the denominator of the ownership. And then if the company doesn't want it, which basically means all of you want it, It goes to the shareholders, and either one of you could then purchase, or both of you could purchase it individually. I'd say that is a standard way of doing it.
Okay.
But there are times where you may only have certain shareholders. So, for example, I've had situations where we can only sell to family members. So we might have some non-family members that are in the ownership table.
Mm-hmm.
The founder or the family members get to buy, but like non-family members don't get to buy.
They don't get to participate in those consolidations.
Sometimes it's founders that keep those rights. Sometimes it's like an investor group that has those rights.
Okay.
The other big question is to whether to do, I described it as company first for the redemption, then the other shareholders.
Mm-hmm.
There are times where it may make sense to have the other shareholders have the first option and do the purchase. And the reality is it doesn't work once you get more than a couple shareholders.
Okay.
It gets really unwieldy.
Okay.
But for tax reasons, if a company buys my shares, and let's just say you guys paid me $500,000, the company went down, you all had your ownership go up, but you got no basis for the $500,000. You guys basically just paid me, right? You functionally just each paid me $250,000. But if you were to buy it yourselves from me, you would get basis and a step up, so that if you eventually sold the company, or if you're a pass through and you're getting losses, you can use that basis. Often cross purchases are used at death for small, like 2 or 3 shareholder companies, and they each get their own individual insurance on the other shareholders to finance that purchase. But when you get 5 shareholders, it gets really expensive and really confusing for one shareholder to buy 4 policies on each of their other partners. So generally speaking, I've seen that it's usually in a professional service firm. Like I almost always have done them in like financial advisory practices, for example. But for bigger places, it's almost always company first. And because it has the centralized resources that can buy the insurance and coordinate all that. We often also have certain exceptions to those triggering events.
Of course, exceptions are what
that's exactly right.
Yeah.
And often, for example, in a closely held family business, often if our plan is to allow intergenerational wealth transfer and ownership, we want to have a mechanism to do that. So we'll often say, look, this buy-sell normally applies if I'm going to sell to Bob, that third party. But if you're transferring to your kids, fine. You don't have to get permission. If you're transferring to a trust for your kids, you don't need to. Those kinds of things, right? And so we'll often do that. Sometimes we do it in other types of businesses, but for the most part, you'll see them in what I'd call traditional, like manufacturing or other businesses that are not solely relying on someone's services, and where intergenerational ownership, it makes more sense. So, because, I know you guys have all been super excited. We've gone through some very dense material.
Yes, we have.
We get to the joys of the valuation. It's all well and fine to say, like, who gets to buy. It's another thing to say, how much are you going to pay?
Absolutely. Is this where the gloves come off?
Occasionally.
Okay.
But again, often, the nice thing about negotiating up front is you don't know if you're buying or selling. So even those who have a really strong inclination to get that last penny, you don't know if you're really getting the last penny that you're going to pay or that you're going to get. And so, you want to be careful. What I'd say is I've listed a number of options that are used. The reality is you can value it in any way you want. I tell people you want it to be objective. You tend to want it to be measurable, or at least like a process that's measurable and objective, and how you're going to determine things. The first one, and I put these in almost all my buy-sell agreements, even though they're rarely actually used, is a certificate agreed value. The idea being, we go and form our business, and we agree, hey, if something happens in the next 12 months and we have to trigger this, this is how much our company's worth. We just decide, we agree every year about what the company's worth. And so if something happens in that 12 months, that's going to be the price.
So on January 1st, for example, we decide, you and I, that our company's worth $2 million. And in October, we lose our biggest client, and we're both sitting there twiddling our thumbs. Our company's clearly not worth $2 million anymore. You get hit by a bus, I get hit by a bus. However, the thing gets triggered, that $2 million is still there.
That's the number. That's the number. Now, what I'll say is, like, if you lost half your business, we might want to talk about amending that at that point. But there is some risk that, like, the timing there, you could stick. We tend to put expiration dates on these. I would say our default tends to be 12 or 15 months. Because most people will do this at, say, the annual meeting or end of the year or something. So we wanted to cover that period and maybe a little longer, an extra month or two. Variation.
In case we get
you know how that goes. But that's one way to do it. right? And it's clean, it's easy, it's usually very certain. We all agreed up front, very enforceable. The second option, and this is often, it's, how would I put it? It's not, you don't actually want to use it, but it is a backdrop around which you negotiate, is getting an appraisal.
Okay.
So say we're a new business.
Yep.
Who knows what we're worth, right?
Sure.
Lick your finger,
Right.
what way's the wind blowing? An appraisal is an objective third-party way to try to set a value that is generally fair to everyone involved.
Okay.
There is a cost to getting an appraisal, right? That's not going to be nothing.
Right.
And so what I tell people is, like, if you have a rough idea of what the business is, we negotiate knowing that there's, like, say, 5,000 to 10,000 of appraisal fees that we can split and keep between us if we can come to agreement. So if our valuations are, if I think it's worth, 100 and you think it's worth 105,
yeah,
guess what? We both have an incentive, just pick a number and be done.
Sure.
We both win. But this, if we can't agree, we're going to apply that appraisal.
What kind of, for our listeners, what's a good estimate for appraisal fees?
Yeah, so, from my appraiser friends, because I think I worry that they're going to be, I would say if you have good financials and, you can be responsive in that, an appraisal is probably going to run between 5,000 and 10,000.
Okay.
Again, if it's really simple, you might be able to get lower than that.
Sure.
If it's crazy and complex, it can go more. But
okay.
If you were budgeting that, that's sort of the backdrop that the fees you're likely to pay. I noted the two things. You'll see I mentioned marketability and minority discounts.
Yep.
For 50-50, I often say that those are not going to apply, or at least the minority discount's not going to apply. But the theory here is a share, when you own 51% of a company and you have control, your 51% interest is worth more than a 49% interest for the same reason no one was willing to accept 51-49 earlier. And so the idea of these minority discounts basically try to reflect that. The challenge is that if you happen to have a majority and then some number of minority shareholders, they all sort of feel like the company's worth what it's worth, and don't we get a proportionate share here? Sure. So you're just going to want to have a discussion. There's not a right answer there. We often use them for estate planning purposes. And there are times where they really are appropriate, and there is a realistic, these aren't just wholly made up by concepts, right? Like that concept has economic reality. Yeah. But you may choose to say we don't want that economic reality to apply the way we're interacting. Marketability discounts tend to always apply. Privately held companies don't transfer like a publicly traded share of GE stock. So that's generally going to depress the price when compared to generally appraisals will often look at comparables and just kind of cash flow models. Those marketability discounts reflect that. Yep. If you're a more established business, you may start considering something like a free cash flow or EBITDA multiple approach. And this is functionally trying to do what the appraisal does, but doing it yourself. And there are limitations, right? But if you had established and relatively consistent cash flows historically, you might say, we value our business at, EBITDA, which is earning before interest, tax, and depreciation amortization, right? So good old accounting term, but functionally means how much cash does this thing throw off? Right. Because that's what we're buying. That's what we're buying. I always joke, like, a business is functionally a machine that makes money, and you're going to pay something for the future money it prints. Right. You're not paying for the money it printed for someone else in the past. And the more money it prints, the more you pay. Yeah. And certain ones in big markets that you feel like have growth potential, you'll pay a bigger multiple. Sure. If it's a very well-established and stable market, you're not going to see more than 5% up or down in a given year. You're going to pay less as a multiple. So often people will either get an appraisal, figure out what that multiple is, and then maybe bake it into the valuation. I mean, that happens. Okay. But also there's many industries have some standard heuristics. Again, it's not perfect. You recognize that you are taking some risk that either the markets change. That does happen. Manufacturer might be going at the trough of the recession, right? A closely held small, and I mean small manufacturer, not like 500 employees small, but like, 10, 20, you might have been going for 2x because the market just wasn't there. Sales were down 30, 40%. Like, you couldn't get a good multiple. But now they might be going for 4 or 5, depending on the circumstances. 5 times our cash flow. 5 times our cash flow. Yep. And so if you lock it in, you've locked it in. So you tend to want to pick a number that is both fair and financeable and all those things. But it's good to reevaluate every few years to see if that still works. On the appraisal side, going back there, Drew, how often is that something that you have to have done I make it happen only when we need it.
Okay, so just at a triggering event.
Yeah, so we do the
Okay.
trigger event. We can talk about who's going to pay. I usually make people split the cost
Sure.
so that they both have an incentive to negotiate.
Yep.
But yeah, that's generally what we'll do. And I often also will say, like, look, if we've gotten an appraisal in the last 6, 12 months, it's going to apply. Like, we're not going to go and get a second one if I got one 3 months ago.
Okay.
But yeah, that'd be the basics.
Okay.
The next option is some sort of, when I talked about the EBITDA multiple, I do want to note, often these things are used to value the enterprise as a whole on a debt-free basis.
Okay.
Right? So often you'll do like an EBITDA multiple approach. You'll add your net working capital. So however much cash and accounts receivable you got, less any payables and debt you've got on the business. So that's one thing to keep in mind. That multiple always looks nice, but if you're leveraged to the hilt, that obviously needs to come off that top line value.
Absolutely.
Yeah. The last one is book value and accounting measures, right? I always say these are useful. My personal opinion is these are useful to look at. You want to know what the balance sheet looks like. There's value and knowledge to have there. But over time, most of the value in the business in that cash machine is not necessarily reflected as an asset on the books of that business, right? Your goal is to leverage those assets to become much more valuable than they show them.
Absolutely.
So sometimes I'll see book value calculations plus some addition for, cash flow or something. But again, book value and accounting measures are fine, but they're not my favorite. I'm generally looking towards, and you'll almost always see one of the first three, and you see the accounting measures less frequently.
Okay.
Yeah. The next item I mentioned is some impact of a third-party offer. As we mentioned, if I'm doing a voluntary sale, and let's just say we agreed our value is that $1 million, $2 million for the business, so my half is worth $1 million, but I've got an offer for 1.5 from Bob to come in and buy my half. What does that mean for our deal between Dan and I? And the answer is, well, we can decide what it means for the deal between Dan and I. Sometimes people will say the valuation is going to be the higher of my third-party offer, or say the appraised value, or whatever the calculated value is under an EBITDA multiple. Other times we'll say it's the lower, right? We don't want to make this too expensive. We agreed this is a fair price and I shouldn't have to pay more than that just because Bob's crazy and willing to overpay me.
Sure.
We had a deal, right? Not a right answer on that. But
are those used very often?
Yeah, so I'll often see, I would say that when I have both in there, a third-party offer, it's almost always on a voluntary transfer.
Yeah.
I would say about 2/3 of the ones I draft have a lesser of.
Okay.
They tend to be smaller, again, like a couple guys who are doing software development, something where their time is really important in it.
Yep.
They want to know that it's not going to be more than that, and they think that's fair. And so they tend to do a lower of that
kind
valuation.
Not to exceed, they know, right?
Not to exceed.
Okay.
That's exactly right.
Okay.
But the other third will do it the other way. If I can get that money from someone else, I'm not going to let my partner keep me away from it.
Okay.
And he can pay that if he wants
Cheat
it.
my family or whatever.
Yeah, exactly. Like, you want me to walk away from a $500,000 from Bob? Like, are you nuts?
So there has to be some qualifiers to that offer being legitimate, obviously.
Yeah, it needs to be a third party. It's not just like my uncle decided to, make me a really nice offer so you could buy me out of that.
Sure.
It has to be a bona fide third party offer. But and generally speaking, you're going to be able to get a match. You'll be able to match it at least.
Okay.
For the valuations, I do these very rarely, but it does come up sometimes. Say, often we'll have sales, maybe it's a retiring shareholder or someone sells to a related party, but they're worried that, how do I want to put this? That they're going to get hosed and the company's going to sell for a lot more tomorrow than I just sold it to you. So,
Absolutely.
Dan, let me buy this out for you for $1 million. I'm going to flip your half.
Sure.
Mine for
I'm doing you a favor, right?
Yeah, like, you wanted some liquidity, right? And I know that there's this other deal lurking out there. Sometimes people will want to build in some sort of clawback.
Okay.
The idea being, and again, these are very much tailored. They're custom. There's not like one standard clawback. But the general principle would be is if there's some other sale in some period of time, I'm going to maybe get a share in part of what I would have received if I kept it. I'll tell you, most people don't want a tail. And I personally, right now, I would never enter that deal. Or I can't imagine the circumstance where I would really want to. But then again, like if I were I've had clients who've been in that situation and it's made sense for them and their families or other shareholders. So, and it's a way of dealing with trust.
Okay.
right?
Yeah.
And so,
Or
right?
lack thereof.
Or lack thereof, right? And so there's no right answer on that. I know I've said that like 100 times, but it remains true. But clawbacks are something you will occasionally see in these agreements and can be used to overcome that sort of informational disadvantage
Sure.
or trust between some
Absolutely.
shareholders. Dan's grinning at me, I feel like, because he's like, yeah, Drew would screw me like
Exactly.
that.
You know about a big client you're going to land.
That's right. I'm going to flip that tomorrow.
I've been working on this client forever. Dan hasn't done anything with that.
You'll never know.
Exactly.
You'll never know.
I'm going to, yep. Okay.
So again, the bottom line is, and bullet point there is the truth, right? The key is finding something everyone can agree on while they're really not sure about what side of the table they're on and what the situation's going to be. Because I find people are way more reasonable when it's not happening right now.
Sure.
So that's a ton on valuation. Yeah, there we go. Payments and financing. So it's one thing to value this thing at my share at $1 million, like we've been sort of discussing.
Yep.
But again, Dan, there's no like massive trust fund out there that you're just going to write me $1 million check.
Not that I'm aware of.
Yeah, me either. So
okay.
My guess is I'm going to need some time to pay this off.
Right.
And so often we will build in right into the buy sell upfront payment terms to give a reasonable amount of time to the buyer to get my interest purchase. We want to make sure that you have the ability. It's one thing to have a right to something, it's another thing to actually be able to perform.
Absolutely.
We want to make sure the person can use the right that they have. So we're often making decisions about what a down payment is. We almost always have a down payment. I just think it's appropriate. Put a little skin in the game.
Okay.
Exactly. And then the balance is usually over time. I will say it's usually anywhere between 3 and 10 years, depending on the relationship of the party. So family ones tend to spread out more. Unrelated third parties maybe over a couple of years or months.
Right. Okay.
You're often going to ask yourself, is there any security or collateral for these transfers? The answer is generally no. The one exception is sometimes you'll get a security interest in the stock you sold. So if they don't pay me, I sell to you, you owe me the $1 million, you've maybe paid me $500,000 of it, and then you default on the last $500,000.
Okay.
I may be able to get part of my ownership back of the company. I can use the shares that I sold you as collateral for the loan that I basically gave you.
Okay.
But at the same time, I'd say most that I write are unsecured. I was joking. If you really can't pay me, probably means the company's not doing well.
I was just going to say.
And great, I now got a quarterback of this company that now is not worth much. But it may be better than nothing.
Okay.
So sometimes we'll grant that security, and that's a pretty reasonable thing to ask for if you're worried about that.
Okay.
Protections for working capital. Sometimes we'll do things like, even if we've got all of these tend to be evidenced by a promissory note. So there's an interest rate. You're often going to get paid something over time for this, and some return for your risk. It tends to be lower than, hey, I'm owed money by a closely held business, that's pretty small. Great. Like, what's an appropriate interest rate for that risk? It's more than 4%, but you'll often see very 4 to 6%, a couple percent over prime or pretty standard.
Okay.
So you get reasonable interest rates, but you are going to pay something. The protections for working capital, again, are another layer of protection for the business. So if the business is the buyer.
Okay, we don't want to starve the business.
We don't want to starve the business. We're going to make sure they're allowed to keep cash reserves of at least $50,000. And if these payments are going to drive me below that, I can sort of withhold those payments and extend
they become optional at that point.
Yeah, or they get kicked out.
Better.
Yeah, we're going to accrue the interest until the business gets better. So that seller has risk. They're carrying that.
Sure.
It's all a question about creditworthiness.
So then we need some third-party eyeballs on the books too,
yeah.
right?
Yeah, and most people, while you have these notes, you're going to want some sort of maybe inspection right or audit right or something like that.
Okay.
The last one there is life and disability insurance. So voluntary transfers, hard to get someone else to sort of be your financing mechanism. You could always go, the business may be able to borrow against its
own
working
assets.
to do that. Yeah, and that does happen. People will often buy out these notes early doing that just to get it done.
Get rid of you.
Yeah, basically, I don't want to have to keep telling Drew how things are going. Adios, buddy.
Right.
Life and disability insurance are one very key and often. My startups generally are not buying life and disability, but my established business clients are generally doing something in this space.
Okay.
If they know that there's going to be an actual transaction. It's not all going to be gifted or inherited. It's going to be, I want to be paid for my shares. So life insurance and disability insurance, life more often than disability are used to finance that.
And the startups, they have no money and the business isn't worth much. So why start?
Well, and
policy type
exactly. Like I can spend 50 or $100 a month, obviously depending on policy size
Sure.
and age and
Yeah,
how much you smoke and whatnot.
Right.
But yeah, like basically they're going to say I can spend $100 a month on this or Google AdWords and drive more revenue.
Right.
They pick their poison and
Right.
they go with the AdWords for
Sure.
almost everything. But yeah, like again, a multi-generational business, or that like dad owns 80% of this, but son is in it and wants to own it.
Yeah.
But you need, if dad were to die, we still need to take care of mom,
Yeah.
right?
And maybe other siblings.
And other siblings, because often with closely held businesses, if you think of that owner, that primary owner's net worth as a pie chart, like
Sure.
it's not like the business is a little piece.
No.
It is like 80%, and then you've got like I've got 4 kids, and I want to be fair and equal to all of them.
Very few
Life
liquid
insurance,
assets, right?
Exactly. Life insurance is how they finance those things, and they just incorporate that as an operating cost as they go.
Okay.
Yeah, so that's the payment piece. Obviously, there's a bit to that, but then the last real big question is taxes. And as you can imagine, whenever you start saying the word taxes in the Internal Revenue Code, you can spend there's whole day seminars on taxations for transactions. But this is
fun.
Yeah, exactly. This is general. The reality is if the company is going to be the buyer, generally speaking, you're going to get redemption treatment. And that means the seller is going to get capital gains treatment. And so the goal in all these taxes is, what is the best tax outcome for the parties? The seller wants capital gains. Right now, of course, I have not gotten through the entire new tax code.
Because that's a lower tax rate.
But it's a lower tax rate. Generally, right now, I think it's going to be about a 10% spread. It used to be bigger, but a 10% difference in tax rate for a seller.
15 to 20 versus 30 type of thing?
Yeah, exactly. Generally speaking, 15%. Now it's going to be 25%, I think, is the top personal rate under the new tax code.
Okay.
So 10%, but it used to be, again, 15, maybe more percent difference. There are certain limitations. Generally, capital gain, you'll have to recapture a few things in an LLC or partnership based on the character of some underlying assets, but for the most part, still true that you're going to get capital gain treatment. The downside of this is you get no stepped up basis in the stock. I mentioned this. If you're the buyer, and say 3 of us, it's me, Dan, and Bob, and you guys redeem me, you're not going to get your basis stepped up because of that money you spent on mine. But if you bought it personally, your basis would go up by the amount you spent on my shares. The nice thing is it is proportional sharing of costs and risk by the other shareholders. It's all in the company, putting it there, and that's where that risk goes.
Okay.
The cross purchase, again, still going to be, generally speaking, it's going to be treated as capital gains. The purchasing shareholder does get that basis in the stock, but as I mentioned before, the more shareholders you have, it gets really complicated really fast. And so most people tend to make that a backup. If you really want to do it, the company can waive and then you can do it. But most people say, let's start with the company because 90% of the time, that's what we're going to do.
Okay.
The last thing I noted here on the tax piece is about installment treatment. So let's just say, you have a business and I'm going to get bought out. Let's just, again, we'll make it $1 million.
Mm-hmm.
Having $1 million of income in 1 year, you are going to be in the top marginal tax bracket.
Yep.
And again, that's a little less important now, but it can
still
drive.
Get eaten alive.
Yeah, you could, you might normally be in, let's say, 15, and now you're going to go to 25 if you do this all in 1 year. When we do the promissory notes where you're going to get paid over time,
yep.
Generally speaking, you're going to be taxed on what's called the installment sale treatment.
Yep, right.
It basically means that, let's just say my gain, I sell it for $1 million and I had a basis, which is basically my cost adjusted for what I've already been taxed on, of $200,000. I have a gain of $800,000, right, that I need to be taxed on. As I get payments of my
big tax liability there.
Yeah, so I'm going to assume it's a lot of gain, right?
Right.
That income, so that $800,000 gain is 80% of my total receipts, so $800,000 over $1 million. Generally speaking, every payment I get, I'm going to have to treat 80% of that payment as capital gain, and then I'll get taxed on it each year. If I spread that out over a number of years, 5 or 10 years, I may never have bumped up to that next bracket for those marginal dollars.
Yourself.
Yeah, and a lot of people, if they're retiring at the end, even though, yes, having it all at once, there's less credit risk. You put it in the investment account, however risky you are, go put it in a CD and get your 1%. You can get a return on it either way, but a lot of people like to see it as income They just like the feeling of getting a check every quarter, month, year. And they want to spread that out over time. So that installment treatment, often it's tax driven, but it can also be driven just by people's personal preferences on how they sort of do their retirement.
And it's very popular.
It is,
right?
yeah, you're going to see it. Again, it's the default if we're going to do a payment over time.
Yep.
You can elect to accelerate that. I'm sure I can think of a couple times where I might do that, but pretty rare.
Right.
Most people are not accelerating those
Right.
things. So that installment treatment.
Keep Uncle Sam that big.
Yeah, that's right.
Okay.
So there you go. That is a ton.
Let's walk through some case studies, of course.
Yeah.
But at the same time, I want to make sure that everyone knows that we have
questions.
Yeah, we have a Q&A bar. So if you have questions for Drew, if you have questions about your specific situation or just in general about buy-sells, please enter those and we'll take them as we have time here. But let's walk through a couple of what maybe you would want to call general or typical scenarios.
Yeah, so we talked a bit about them as we went through, right? But I'd say my first one is it's the startup founders, whether it's a manufacturer, whatever business it is, personal services, a standard buy-sell. They're the ones that most easily fit into the box because the business isn't worth a ton, but they want some limited protection here. And so they tend to get give me the thing off the rack, right? And that's going to be a right of first refusal, meaning there's no mandatory purchases by involuntary and voluntary transfers, death and disability. Those four plus the voluntary nature of it, I'm going to offer it to my partner first. But if they don't want it, they don't have to buy it. That's a very common baseline. And I'd say that is the plain vanilla buy-sell. And of all the buy-sells I write, they're incorporating almost every operating agreement I do. So they are very common, and that is pretty much always a baseline. The ones that get more complex almost always are an established business that is looking to have someone retire or transition out.
Yeah, let's talk about that. Let's talk about father-son type of thing, or mother-daughter, whatever it might be. Yeah,
so a father-son example is a great example. Let's assume the business is fairly valuable.
Sure.
And excluding sort of estate tax things, but often what we'll do is we'll do some gifting over time. To do some planning for this. But often dad wants to hold on to the income until he passes and he wants it to go to mom. So we will often have a buy-sell that will either give the son the option to buy at dad's death. We'll often fund that with life insurance paid for by the company. And then the estate, so if your dad, let's just say your interest is worth $10 million, if we could get a $10 million insurance policy on that, and I have 4 kids, dad passes away, the company buys out that $10 million, which basically means the kid who has the last 20% or whatever owns the whole thing now.
Right.
But at the same time, there's $10 million of cash up in the top here that's going to get distributed back out to all the kids. So each kid gets $2.5 million of cash. Son, the company basically bought itself, and son can get this carry, and that's really a sweat equity. That's a very common structure. The other one is we give it to the kids, but we have a buy-sell set up because we want it to stay in the family. We don't want it to go to an ex-wife or ex-spouse of any sort. We don't want. We want to make sure that management stays. We often will set up non-voting and voting shares. So if you're active in the business, maybe you get a vote, but we'll let the economic rights spread out. But the management's going to stay with the people who are in it, and we can get it. You can get very creative and complex. We've also had ones where father-son is actually pretty straightforward. You tend to have life insurance. You tend to give that kid a right to buy it out. They're going to fund it with that life insurance, and often we will wait until dad passes away, and he'll either inherit some or he'll buy some of it out.
How do you keep the other siblings treated fairly in that scenario?
So again, it's all about, I would say,
fairly, not equally.
Yeah, but I'll tell you, most people, when you're talking about your kids and what you want them to have, often fair is equal in their mind. Not always, but frequently. And so again, I will say, so let's just say we didn't do a company buyout, but dad is trying to figure out how to get it to the kid. He could give some of it, but his will or trust or whatever ownership structure he sets up may say, I want this to go to my son. The business is going to go to the son. All my other assets are going to go to my other kids to get equal value. And if I'm short, either the son has to buy in or often you know how much you're short.
Sure.
You'll buy your own life insurance to finance the difference, so you can fill up each of the buckets equally.
Okay.
And so that's not always in a buy-sell, but often the buy-sell will play into that and what the son's rights are, or the next generation, whatever it happens to be. And then, so it's, you've got one branch, but as you can imagine, if you've got a family business, maybe you're 4 branches down. Often your buy-sell is trying to figure out, like, how do we manage this now? There is no controlling shareholder, and only some of us are still engaged, but we've decided that this is family wealth and like everyone can share in this.
Yeah.
So governance becomes really important. How some people want to do branches of the family, get like board seats.
Yeah.
And so that would be in a buy-sell or something like that.
Would.
Often, and I say buy-sell, often these are also called shareholder agreements, so they broaden the scope a little bit.
Family constitutions.
Yeah. Yeah, exactly. And so it's all about what terms you get in there, but you'll see those kinds of things. You'll see, maybe you'll reward. Hey, if there's a family member that is running the company, maybe their share from like inherited from great grandma is 2%, but we want to incentivize the people who are here and committed to do that. So we may allow the people active in the business to buy, say, 20% of the company, but they got to sell when they're done. Right? These might be the employee shares. And they get it, and they get all the appreciation and value while they're driving value for the company. But when they're out, and that doesn't go necessarily to their kids. So you can get
it
really
goes to the
creative.
next guy or gal who's going to create value in the company.
Exactly. The company buys it back. They're going to issue it to the next person who's really driving value. And sometimes that 20% isn't even limited to family. And there's other alternatives like. So it gets crazy, but you can do stock appreciation rights or other sort of pseudo equity things to get the same result. And again, all those are not always in a buy sell, but they often impact the way we're going to manage that ownership and deal with those transitions.
So how about I wrote a buy sell 15, 20 years ago with my partner. It's sat in a drawer this whole time. What are the things to look at within it to, see, is this still current? Do I need to go,
As silly as it sounds, like, this was 13 slides, I think, of which probably 4 were like title slides. Walking through something like this to say, hey, what do our circumstances have changed. We were the scrappy new business 20 years ago. Now we're a well-established cash flowing business today. Are these the trigger? Like, do we need to sell to each other, or can this go to my kids now? Are we okay with this? Because we built a whole management team. We're both retired and
so maybe everything is kind of back up for debate potentially?
I think it's back up for debate. And again, you're reassessing your goals. Your goals on your day one of starting the business, if you really do succeed, may very well have changed. And then you just want to reevaluate, is it still serving our needs? You'll often end up talking more about estate planning. And I'll tell you now, as someone who does estate and this sort of transition planning, the new tax rules, there are not that many people. There weren't very many it used to be the estate tax exemption was $5 million per person, and it was adjusting for inflation. So a couple had $11 million to work with. There weren't a ton of people that walked into my office like, I need to worry about tax planning for the estate tax. We've doubled that now. That pool has shrunk dramatically even further. Right? So often I've been asked a few times, why do I need buy-sells then? And I said, because, or any of this sort of estate planning, because tax planning drove it some. And there was a lot of value in that, and it was easiest to measure. I love being able to say, like, look how much I saved you. It's like 10 times the size of my bill. Like, this is the best deal you ever made. I don't get to do that as much anymore. But I do get again, if this is the golden goose, if it's a family legacy, the governance issues, understanding what the expectations are for the next generation, often we'll have qualified heir provisions. This is what you need to do to stay an owner of this. Those things
that can be built in.
Are all still really important to people. And if you have a $10 million business, fine, you don't have a tax issue, but like that's still a big, that's a big asset that you want to deal with appropriately. So that's what I tell people is like, we're doing even the proportion of our work that was tax focused is shifting a bit, and we're doing more and more of the planning transition, the governance stuff. We did it before, but everyone came in talking tax.
They all wanted to save money.
They all came in. Yeah, that's right. That's how that was your lead.
Made for an easier sell too.
Oh, it sure did. Let me tell you, there's nothing like that. It's you and me versus the IRS. Like that's an easy sell.
How about businesses who don't need a buy sell? Who doesn't need one?
Need is relative, right? I always joke like, how would I put it? It's insurance,
Yeah.
and you get what you put into it in time and effort and thought. But the basic one covers most situations, what you'd want. But if you're willing to take the risk, a handshake works frequently, right? Like, I know a lawyer's not supposed to say that. The problem is like, it may work 80% of the time,
Yeah.
but the 20% is really miserable.
Sure.
And so you have to make a decision
Yeah,
of how miserable.
bloodsuckers like you get involved.
Yeah, and it's, again, sometimes you think, but like Dan and I get along great, we'll always be able to agree, and that may actually be true. The challenge is that the things that a buy-sell addresses, it's often not going to be you and me debating.
Sure.
It's going to be me and either one of
My
your kids
spouse,
or a spouse or their lawyer, and their thoughts on what's fair and what they'll agree with me are different than you. And so I would say, again, I think I said this earlier, this is one of the few things I will do organizational documents without it, and I will say, I will, if you don't want it, I won't make you do it, but I highly recommend it.
Okay.
And again, I realize, yes, I'm doing the work, there's fees in that, so you can take it with as much salt as you want, but it's one of those things where upfront this is a couple $100 extra to get done the basic vanilla plan, right? And if you end up in a situation where this, it will pay for it multiple times over.
Okay.
And do you need drag and tag rights? No. Do you need to get into all the details of all that? Probably not. But the basics.
So the basics. Let's put put your used car salesman hat on here for a minute. And I've got a small firm. It's worth less than $1 million at this point. I got a partner, and we come into you and we want, the boilerplate type of thing. Can you give me a range so our audience kind of knows that this isn't a $10,000 investment?
Oh, yeah. Take a zero off.
Okay.
Right. So like if you come in and say, look, I want a standard right of first refusal buy-sell agreement between us, and I want it valued. My question for you would be, how do you want it valued? Like, do you have could we do a financial measure? Do you have that kind of good enough financials to do that?
Right.
Or do we want to just like certificate agreed value and appraisal? Right? That's going to be my default.
Okay.
Unless you tell me otherwise. And they say, yep, that's good. We'll get the names. A standalone agreement there is going to be between probably $500 and $1,000.
Okay. All right.
Again, if you roll it in on the initial organization, in some ways, like you save a little.
Sure.
But standalone,
the 2-for-1
later,
deal, huh?
Right? Well, just like we've built out that process.
I understand.
But you know what
I understand.
So that's right. And you get free air freshener if you come. And,
okay. All right.
But
all right.
Yeah, I mean, and again, your situation a little bit, but for very simple, father son, this is our plan. I'd say let's get a basic right of first refusal, and then don't spend a ton on that. Go get an insurance policy.
Okay.
Let's make sure son has the option to buy. Let's make sure there's financing available to get the son to be able to buy.
Okay. Make sure it's
because at $1 million business, usually dad or parent still wants the cash. They need the value and the income.
Sure.
They can't just say, well, I'm going to die with it and I'll let you. Yeah. They need that value. They can't just gift it away when they want to retire. So that tends to be the way, or we'll just build out, hey, when you decide you want to sell or at 70, son gets to buy you out. Here's how he's going to buy you out.
Okay.
Because son otherwise wants to go and work somewhere else.
Any quick nightmare situations that were nightmares that grew out of very simple, what could have been very simple agreements on the front end? Had they, or even not a nightmare, but just, boy, I wish we didn't have to go through this, and it all could have been avoided by doing this.
It sounds silly, but like the conflict benefits one person at the end, and it's the lawyers of everyone. I guess more than one person, because there's lots of us that get in on that.
All right.
But
it's a giant sucking sound in the room.
I mean, it is, and I'll tell you, I work on some of those. They're heartbreaking, and sometimes the fighting. There was a guy I worked with. He had like a farm, and it wasn't even an entity. So there's like farmland, and you had no kids, lots of nieces and nephews, and all that, right? And like, no one knew what the value was, and one nephew's like working the farm and losing money, and like, all of this could have been avoided with like some consolidation of like that structure, and some thought about how governance was going to be dealt with. And that family, I mean, they sued each other, right? Sisters and brothers and cousins. And it's a little heartbreaking. Oh, and who won in that?
Even for you.
It is. Oh, I always joke.
No, I'm just kidding.
But don't get me wrong. There are times where I felt like the other side was a jerk, and I enjoy an occasional fight, right?
Sure.
I mean, I like to argue. I went to law school for a reason, but for the most part, we want to get a deal done, and you care. I mean, my clients, the hardest thing, if I've every once in a while, it's like, would I ever want to go start my own business, right?
Mm-hmm.
The hardest thing for me to imagine is like leaving my clients and like calling all these people who sort of feel like family in a way. You were there often on day one when they had, 2 nickels and an idea on a napkin.
Right.
That thought is really hard, and you hate to see them waste so much when, like, guys, like, there's no winning. We used to joke, estate fights are almost always about who loved, who did the parent love more, me or my brother,
Okay.
right? Guess what? The estate court, the probate court, and your lawyers are not ever going to be on.
Cares.
Like, the result that you get here will not actually answer that question.
Yeah.
But there's a lot of emotion that goes into that. Doing these things up front. And I always say, like, often it's not about doing it for yourself. You're doing it for your kids and the next generation. So.
Okay.
Yeah.
Any last parting shots here at 1 o'clock? We were hoping to get to Matt Damon, but we've run out of time. So I apologize to him. But next month, I'm sure we will do a better job with that. Next month, we're going to be talking about golden handcuffs. So another key piece of the succession and exit planning space is, how do we keep key employees from leaving us when we're getting ready to sell our business? And so we'll be talking about some of the different mechanisms involved that can be used to kind of, for lack of a better word, handcuff key employees to your business. So Drew, we
properly align incentives.
That's right. We're all on the same side of the table now, right? All right. Well, I appreciate your time today. Appreciate your time, Drew.
Yeah, it's a pleasure. Thank you, everyone.
Thanks for all our guests, and have a great rest of your day. Thank you.